Alrighty, thanks for tuning in to Money Mondays. I am Shani Curry Saintville, and thanks for tuning in. So, for those of you who have been sending me tons of questions about your 401k, I wanted to get an expert in that can definitely give you guys some insight on how you should be navigating with your 401k during COVID. I do have a few giveaways as usual, right? For those of you, here's my book, 10 Things Every Woman Should Keep in Her Purse. So we're going to be chiming in for those questions, and we're going to be, for the questions, we'll do some giveaways, okay? All right, so tune into the conversation. I'm just going to open right up. Courtney Richardson is someone that I admire. I always admire women who not only have an understanding of saving, right? Saving is a really great place to be. Saving money, being able to manage your credit score, but being able to leverage your money is a whole different conversation, right? Saving is one conversation. So if you get to do that, great. But once you're able to do two things effectively, being able to protect your money from two things, taxes and inflation, it really means that you are really maneuvering in a way to really put some purse empowerment in your purse. All right. So I'm going to bring Courtney in, and she's going to begin to share with us a little bit about how to navigate your 401k. All right. So here's Courtney.
Thank you so much for having me.
You're welcome. You're welcome. Okay, so we're going to go ahead and get the conversation started with some of the questions that we had in the comment section. A few people are just, one of the major questions that I received was, should I just take my money out of my 401k? I received a lot of, I received a lot of commentary about maybe I'm just going to take my money out. And what's your perspective after managing 401ks for very large companies? What is your idea on that?
No, no, and no again. So here's the thing, and I get that. So I want you guys to think of it as managing retirement, preparing for kind of the next phase of life as a marathon. It's not a sprint. So we're like in mile like 13, 10, and now our knees are starting to hurt. We're starting to really feel the pounding of the pavement. And this is kind of where you have to buckle down and kind of remember your training. So that you're kind of going, I ain't trained for retirement. I don't know anything about it. I don't know. So I really share that with people, is that you gotta buckle down. You have to focus on what's important. So here's the thing. I tell people all the time, begin with the end in mind. Like, that's what you need to focus on. So you're like, well, what's the end? Well, you're trying to retire, right? And so you need to think about a couple of things. One of the things, and I love the conversation that you had about, managing against taxes and inflation. So the big thing is that you're trying to put yourself in a position where you have kind of the most money available for retirement. And that means like retirement and retirement, when I mean, how do I explain it? Retirement in terms of like, sipping on the beach, drinking Mai Tais, retirement in terms of being older and having increased health expenses. And then on top of that, it's a function of just living, kind of figuring out how you're going to live and what that means on the other side. Because again, you don't really have what we consider like the job income anymore. So what are we going to do? So the question is, how much money do you need in retirement? And a lot of people don't know. So there's really two ways that you can think about retirement and how much you need. So we have the expense model, and then we have what we call the income model. So with expenses, you're saying, okay, what are my monthly expenses? Time that by 12, and then you times it by 25. And that's kind of the pot of money at least you should have to cover your expenses. Now, the way we make that a little bit easier is that we try to reduce that number is we reduce our expenses. So when I was retiring, so just kind of as a background, I like to tell stories because I think stories are the most relatable. So in 2005, my mom was 55 and she came to me and she said, hey, I want to retire in 10 years. I want to retire at 65. And I was like, okay. And the thing is that, most people are like, oh, I want to retire at 65. That seems normal. Well, there's a couple of different wrinkles she had going on. One, she was laid off. Two, she was bankrupt. And 3, we just used the $10,000 that she had in her 401k to actually catch her up in her bankruptcy. Not a great situation for a 55-year-old. So I share that story to say, okay, fast forward 11 years, she ended up retiring comfortably. So you're saying, well, she said 10, we did 11. Like, yeah, well, that's kind of the things that I tell people. You're going to change you're not changing your goal of retirement, but you might have to change your method. So you might need to add another year, or you might need to save more. You might need to do a couple other things to kind of make your goal, your big picture come into play. So what we ended up doing is that we were able to get rid of her expenses. So she had a house with a mortgage. So I said, okay, she has a house with a mortgage. So let's retire that debt. But let's also at the same time, and this is super important, especially now, is that as you're retiring debt, you're dealing with what happened in the past, but you're also dealing with what's happening in the future, or what will happen in the future, which is your retirement. Because a lot of people are like, oh, I have to pay off the past, before I can deal with the future. Huh? Huh? No, you're living the future. So we're just going to ignore it, and we're just kind of going to put the blanket over our heads until we pay off our debt. No, that doesn't make any sense. The thing is that when we're planning for retirement, when we're planning for anything that deals with money over the long term, time is not on your side. So you have to do both. Now, sometimes that means that you contribute $100 to your debt and $25 to your retirement. But as you pay down that debt, you're going to be contributing $50 to your debt, and then we're going to be contributing $75 to your retirement. And we're going to try to keep increasing it. And that's kind of the play that we're making. So that's what I did with my mom. So what we did, we got rid of her mortgage. Well, first, let me back up. First, the very first thing that we did is we got rid of her bankruptcy. Because bankruptcy is a Chapter 13 bankruptcy. And just let me give you some backgrounds on what a Chapter 13 bankruptcy is. There's 2 types of bankruptcy for a person. There's Chapter 7 and Chapter 13. So Chapter 7 kind of wipes your slate clean. That's pretty much if you don't have any other assets like a house or something like that. Usually, most people that are individuals are trying to save their house or some kind of big asset from usually from foreclosure. So that's your Chapter 7 wipes everything clear. And it's usually like what we consider unsecured debt. But on the Chapter 13, it's basically a reorganization. It's like, listen, I need you guys to come in and y'all have a conversation about how we're going to pay this debt off, but I certainly can't pay you what I owe you. So let's figure out how we're going to do this. So your secure debt deals with it. So your house is considered a secure debt. If you have a car, that's also considered a secure debt. Like if it's attached to a thing, that's a secure debt. Now, if it's not attached to a thing, like a credit card, that's unsecured debt. So the thing is that in this Chapter 13, everybody has a conversation. They have what's called a meeting of the creditors. So they have this conversation and saying, okay, well, this is what we think we're going to bring her debt down. This is what we're going to bring the debt down. And then that gives you a monthly payment that has to be paid to the bankruptcy trustee, in addition to keeping current on your obligations. So your house and all these other things. So like I said, we had to get rid of the bankruptcy. So the bankruptcy was $800+ a month. Then she had to pay her house, which was $1,200. So it was about $2,000 that was going out the door before anything else was paid. So of course we're like, okay, let's deal with that. We got rid of bankruptcy, and then we were able to contribute. We always contributing some money to retirement, but not a lot. But as bankruptcy went, we were done with that in a year. So we said, okay, let's move on. Let's take care of the next step. And so the next step was that, okay, now we're looking at paying down the house, but still dealing with retirement. So it was kind of like a push and pull in terms of dealing with debt. So we pay down the debt and we still save for retirement. You have to do both. Like we have to multitask. And a lot of people feel like, oh, I can't. But it's like, that's why you have a budget. That's why you lay out these things. Because again, we can't be saying, oh, I'm going to wait until my debt's paid off in 5 years, because you lost 5 years of time that you need. You really need it. And the thing is that, like, again, no one teaches you about retirement. No one has a conversation with you about, hey, this is how you save for retirement. I mean, when we come into a new job, they hand us our paperwork and said, here's your medical, here's your dental, here's your 401k. Have a good day. How? So I can't hear you. I think you're on mute.
So, all right. So we got another question from Stacy Ann, and Stacy Ann wanted to know, why is it that she lost $3,000 from her 401k? I mean, I know you don't know exactly, but you can kind of zoom in to talk about how these type of situations will create loss in your investments.
So here's the thing: the stock market, when the stock market goes down, 9 times out of 10, your 401k is going to be effective. So what happened a couple of weeks ago is that everybody was, I shouldn't say a couple of weeks ago, before pre-corona, beginning of February, the stock market was at an all-time high, highest it's ever been. So everybody was excited. But we always tell people, like when we're having these conversations about the stock market, is that the stock market was due for a correction. The stock market was really, really high, and we were in the period of the economy. Like, think about it as like a roller coaster. Think about the stock market as a roller coaster. Okay, so you get on the ride. So when you're getting on the ride, that's kind of like the beginning of the end of a recession. Okay, just think of it that way. So we're getting on the ride. The ride is the roller coaster is going up, 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 up. And then what happens? You hit a top. You hit the very top of the roller coaster, and then what happens? You shoot down. Think about that as the economy. So we got on in 2009, at the bottom of, the Great Recession. March 2009 was the bottom. We got on, and we've been rolling that thing all the way up until February 2020. So it's February 2020, life was good. It was at the top, but then Corona happened. So Corona was that dip. It just kind of went crashing down. So that's what happened to the market, and that's what happened to your 401k. So the reason why everybody's upset about like what Corona did in terms of our COVID-19, how you want to talk about it, what did it do is that honestly, it started in China, and China is the world's second largest economy. So with that being said, is that they have think about it this way, it's like they have the major players and playettes, okay? Major players, playettes in the world, and they shut it down. So my Apple phone that I have over here, my Apple computer that I'm on, it couldn't get made. So many major companies have what we consider part of their supply chain, kind of the way they make their products or do their thing in China. And then on top of that, they have consumers. China's like the biggest population in the world. They have all these consumers there. So you have a lot of stuff is made there, a lot of consumers there, and then they shut down because of Corona. Imagine what that does. And then adding on top of that, let's talk about oil. So everybody's like, this gas is as cheap as it's been in the 90s. I'm like, yeah, but here's the thing. There's too much supply in the market when it comes to gas. So what we know about supply and demand is that when there's too much supply, when we have too much supply for the demand, the price comes down. So that's what happened. So China used to run through millions of gallons of gas to kind of run their factories on a daily basis. And like I said, they shut down. So what do you think happens? They have all this supply that's kind of floating around. And the demand's not there. So it pushes down the prices. So that's what's been going on. So you have this kind of, COVID thing that happened in the market. So that pushed everything down. And like I said, we were already kind of due for a correction. So that's the first thing. And then on top of that, then we have kind of this oil thing going on, which we're excited about because we're like, ooh, cheap gas, but where's everybody going? Because everybody's at home. So there's a lot of different things going on. So the reason why, in short, why you lost $3,000 is because the market lost a lot of money. Now it has been rebounding, but there's an uneasiness because here's the thing. The market's not going to settle out, honestly, until first we get the disease under control, and we're not there. As you heard, the president, basically the White House has been affected. The press secretary for the vice president has COVID. There's a couple of different major people in the White House that have it. Dr. Fauci's now under self-imposed quarantine because he was exposed. So again, we still don't have a good handle on the virus. And then on top of that, all the companies that have kind of been adversely affected, whether it's from the shutdown, from the supply chain, all those things, we're not going to know first what's going on until we get everything under control. And then after everything's under control, we have to look for a couple of months out to see how that's going to affect these companies and affect their earnings. So we're kind of in this for a long term. I mean, I think we're probably going to be waiting another, 12 to 18 months before everything settles out. So kind of buckle up. It's going to be a bumpy ride, But what you don't need to do, and this is something that you asked earlier, is take your money out of the market. That's not what you need to do.
Okay, so in terms of the conversations, because a lot of people, especially specifically women, this is not something that we talk about on a regular basis. You understand? We have different levels of conversation. So a lot of it, because it's not so much that we can't learn about it, it's just not the normal conversation. It's not what you talk about in a hair salon. It's not what you talk about with your friends unless you have the different types of friends. So oftentimes, because it's not conversed about on a very frequent level, it feels fearful, right? Because you don't talk about it enough. You know, if you talked about it more, your fear will begin to reduce, which is partly why we're having this conversation today. So, so most people probably do not invest outside of their 401k. They don't. You know, that is probably their only investment tool outside of the purchase of their home, because the language, the jargon, the loss attached to it, the fear attached to it is just not a common thing. So what type of conversations would you recommend that an employee would have with their 401k manager? Like, what would that conversation go like for you?
So for somebody who's looking to invest outside of their 401k,
they're looking at their 401k and they're seeing these losses. You know, every week they're seeing losses. Every time they get their perspective, they're seeing losses. What would you recommend that conversation look like when they were speaking with their investment advisor, if they were speaking with who's managing over their 401k? What would that conversation look like for you if you would give us a guide?
So the first thing is that, so I'm going to use some terms and we'll define the terms, is that how are you allocated? What's your allocation? And you're probably going, what's allocation? I don't know. What your allocation is how your account is separated between stocks, which we're looking for them to grow, and then which we're saying growth, your growth part of your portfolio, and then your income part of portfolio, kind of like this regular, how do we say, like your regular money coming in as like a regular payment in terms of bonds. So you have your growth side, which is your stocks, and then your kind of more stable side, stable because bonds have been pretty terrible, your stable side of your bonds. So you want to look at your allocation. So one of the things that I've personally noticed across the board, especially when I'm talking to women, is that their allocation is messed up. So they're telling me, hey, Courtney, I lost $40,000. And they're like 7 years out from retirement. I'm like, you know, and now granted, if you lost $40,000 and you have a substantial retirement portfolio, that's not a really big deal. But then when I'm like kind of looking at their assets, I'm like, well, you should have lost $40,000. And then I see they have too much money allocated towards growth as opposed to stability. And as you get closer to retirement, the more you should be stable. But I've also seen people on the other side, people around my age, you know, your age, saying, you know, like they'll say to me like, oh, well, you know, I'm afraid of losing money. So all I have, all my money is in cash. Where they do that at? You're not getting anywhere because if you're in cash, cash is not going to keep up with the rate of inflation. Inflation happens around 2% every year. And we all know that these savings accounts are not doing anything about 2% is like a good rate. So if your 2% is a good rate, what is that going to do over time? You're not going to keep up with inflation. So your dollar that you save today may be worth 80 cents, you know, when you need it. And that's not fun because what happens with prices? We all know prices, except for gas, which recently go up over time. So what are we going to do? So again, you have to invest in the market based on your age and your risk tolerance, that you have to do it. And it's not fun. And again, you said perfectly, we don't have these conversations. So I tell people as like a little rule of thumb, take 100 minus your decade, and then that should give you how much you should have in stocks. And you're probably going, huh? So 100 minus, I'm in my 30s. So 100 minus 30 is 70. So I should have about 70% in stocks. Now, if you want to be more aggressive, which I think women should be a little bit more aggressive than that standard, and here's the reason why. Women live longer. So if you live longer, you want to have a lot more exposure to the growth section of basically try to keep up with inflation. So usually about 110, so anywhere between 100 and 110. So 100 100 minus 30, which is my decade, which I'm in my 30s, it gives me 70. 110 minus 30 gives me 80. So about 80% in stocks, about 20 to 30% in bonds, kind of that allocation. But if you're in your 30s and you have 50% in bonds, oh no, baby, what is you doing? So again, it's a balance on both sides. But if you're closer to retirement, so if you're in your 50s, I expect you to be somewhere about 50-50. 50% in stocks or growth and about 50% in bonds. So again, that kind of stable aspect. So bonds, just to put it in perspective, because no one really talks about bonds. Everybody talks about the stock market, but nobody really talks about bonds. So bonds are basically company or government debt. So a company says, hey, we want to build a new facility. We don't want to issue more stock, which is ownership. We want to just, basically pay for it in debt, kind of have people, have us pay people back with interest, and we're done with it. We're going to leave the party. So if a company said, I'm going to build a factory for $1 million, we all know that that's cheap. We're going to build a factory for $1 million. They could actually issue stock. They could issue more shares of ownership. Or they can say, oh, we're going to engage in some debt. So it's kind of like, think about companies as people. Because if you think about companies as people, I think they're a little bit more easier to navigate. They're like, hey, we need more money. Well, I have the option of kind of like selling something that I own, which is ownership, stock, or I could actually finance something like finance a car or a house or some kind of facility. And I can do that through debt. So just think of it that way. So, with debt, if I have a mortgage payment, I pay my principal and I'm paying interest. Same thing with bonds. But sometimes bonds will just give you a principal payment. And then at the end, what we call the maturity date, then you get your initial principal back. So there's a lot of different things that you can do with the stock market and how these things work. But I want to give you that idea of kind of that's our framework. There's a question that I actually saw. She said that the bankruptcy, she was asking me about my mom's bankruptcy. She said bankruptcy doesn't replace the debt. It depends on the type of debt. Either way, the debt, once you complete your program, whichever program you're in, it does erase the debt. So it depends on how you're set up. The 7, everything kind of once you get through and you're discharged, you're done. However, you're 13, before you can get discharged, you actually have to pay the amount that's set by the bankruptcy court and the trustee. So you have to pay that back. It usually takes people about 4 to 5 years. My mom, I think, did it about 4.5. So I just want to clarify, Chapter 7 wipes everything clean. Chapter 13 is usually when you're trying to protect the asset like a house. And that basically says, hey, we're going to restructure that, kind of clean this stuff up. And then at the end, we'll discharge you, and then all the debt goes away. But that doesn't mean that your debt when your house goes away. That means that whatever the back debt was.
Sounds good. Glad we were able to answer that one. Okay, so the other question that we had came from Miss Chambers. She wanted a recommendation as to whether or not would it be better at this time, because she's finding what she wants to know, would it be better to take a loan against it or just to do a withdrawal as it relates to her 401k? I know that's extremely situational.
So it is situational, but the question I usually ask people is that, what are you doing for? That's like the bottom question. Why are you doing it? So here's the thing, and I tell people about loans and withdrawal. So a loan is something you pay back every single pay period, and you pay it back to yourself. One of the things about the loan is that the money that goes from your loan, so you're paying it out of your check, and it's after tax. But remember, it's going into the pre-tax bucket. So technically it's going to get taxed twice. I wish I had like a little chart so I could show you how it works, because a lot of people are like, what? Just know that you're paying the money back to your 401k after tax if you have a loan. That's not taxable unless you leave the company. And if you leave the company and don't pay the loan in full, it's considered what's a deemed distribution. So a deemed distribution means you still have a balance on your loan. You stop paying it. So now it becomes a withdrawal, whatever's left on the loan. So that's how it works. But I tell people, don't take loans if you're looking to leave. If you're looking to leave a company, like in the next 2 to 3 years, or collapse your loan time. If you're going to leave the company in 2 to 3 years, saying that your position is pretty stable, stable, whatever that means during COVID, then I would say, like, if you're looking to leave in about 2 to 3 years, that I wouldn't take a loan out longer for that, because what's left on the loan balance will become a deemed distribution and you'll have to pay taxes on it. So put in perspective. So if you took a $20,000 loan and you left the company in year 3, it was 5 years, and you had $10,000 left and you don't pay it back, you leave the company, don't pay it back, you don't write the company a check for or with your 401k a check for $10,000, and you made, we'll say, $50,000. The government's going to say, oh, well, Courtney made $60,000 in this year. She made $50,000 through her job, but she made this $10,000 as a deemed distribution. So you're going to get hit with regular taxes. And if you're under the age of 59 and a half, you're also going to get hit with a 10% penalty. So those rules have changed a little bit with COVID. So some of the rules regarding loans have changed. And I actually did a piece on it. There's a couple of different things that you should know. I think I wish I grabbed them for you guys, but there's some of the rules have changed a little bit. So for example, I'm sorry.
No, post it in a comment, but tell us now.
So a couple of things. So before, you can only take $50,000 or half your vested balance, whichever is lesser. Now you can take $100,000 or your entire vested balance, whichever is lesser. So basically double the amount that you can take on a loan. So that's the first thing. Now, also with the loan, I think they're not making people pay back. I think under the rules, I think you have maybe until about January or some other time outside of directly now. So that's your loans. So loans we can talk about all day. Now, in terms of withdrawal, if you take a withdrawal, now here's the thing. If you are working for your company actively, you may not be able to take a withdrawal. Withdrawals, you have what's called an in-service withdrawal. So that means you're working, you're in service with the company. Some companies do have what's called an in-service withdrawal available. But you also have a hardship withdrawal. Hardship withdrawals are certain reasons that you may need to access your money. If you're getting evicted from your home, if you have foreclosure, if you have to pay for funeral expenses, if you have to pay for college, if you have medical expenses, and there's like two other things that you can get a hardship withdrawal for. But remember, hardships withdrawal from your 401k is going to be taxable as ordinary income. And not only is it ordinary income, but it's 10% penalty. So I think they may be waiving the penalty. Offhand, I can't remember all of those rules because of COVID. There's a lot of different things that have been changed based on what's going on with the coronavirus and the CARES Act. So a lot of this is housed in the CARES Act. But overall, if I had a choice between the two and I had the ability to pay it back and I was going to stay for the company for a while, I'd probably do a loan. But again, the loan is your worst. Like, a lot of people are like, I want to take a loan so I can pay off my student loans. Don't do that. You have a lot more flexibility with paying back your student loans than you do with taking a loan out of your 401k. And also remember, you're running out of the market. So yeah, you're paying yourself back with interest, maybe, and interest is really low. So maybe 4%. But if the market kind of turns around, you may be losing 5% every single year. So again, it's a thought that you really have to think it through. And then also, it just may not make that much sense for you, but talk to somebody outside of like your circle. Cause a lot of people don't have these conversations, but this is the conversation that you should be having. Like, does this make sense? Have a conversation with your tax preparer. See if there's other ways that you can go about it without touching your 401k. Like, your 401k is like beyond a rainy day. Like, the 401k is like you're in the ark. There's a hole in the ark. You're rowing and it's just not working. That's what the 401k is. So I want to put that in perspective. But some of the things that I think a lot of people need to focus on is that you should have an emergency fund. A lot of people get excited about the sexiness of investing, but you have to have an emergency fund. You have to have that $1,000, $2,000 set aside for emergencies. And honestly, we all know, looking at COVID, that's not even really enough, but that's like your base level. So again, it's about looking at everything that you have going on, saying, okay, I do have other options, or I don't. And I don't want people to say, like, I don't have any other options, I'm terrible, I'm just going to thug it out and do nothing. Like, well, no, that's not really an option. If you have the loan that's available to you, take what you have available, but just know that that's your last option. But if I had to decide between the two of them, I'd probably go for the loan. But if you don't have a way to pay it back, you might need to do it with them. And the way the CARES Act, that's 3 years to kind of pay back that tax penalty.
Got it. Got it. All right. So we're going to wrap up with just our last question, Courtney, and let you share your perspective on this one. This is one of the questions that have probably come through my inbox and my email very frequently. The question is, should I take some of the proceeds from my stimulus check and invest it in the stock market?
I think so here's the thing. Before you invest in the stock market, do you have an emergency fund? And then my next thing is, do you have life insurance? Life insurance is getting a little crazy, so, are you protected? I always tell people before you kind of jump out, make sure that you have your life vest on and you kind of put your mask on, literally and figuratively, unfortunately now. So those are those things. But if you have your emergency fund, you definitely have, you have your emergency fund and you have like life insurance, and you kind of have that basic stuff taken care of, and also a debt management plan. I don't want you paying off debt though. I mean, like if you kind of just been paying off and doing what you're supposed to do with your debt, I don't want you to say, "Oh, I'm going to take the stimulus check and pay off debt." No. I mean, go ahead and learn about the stock market. But I think the biggest thing is that people don't know about the stock market. You said this before, is that we're not having the conversations. And women are actually better investors than men, but they take longer to get in the market. So it's like, once you get there, you're good. Because again, think about the stock market as like the market. And when I say by the market, I really like to share with people is that think about the stock market as the market. When I go to the supermarket, I'm just like, oh, okay, I have $100 to spend. Am I going to spend it? Am I going to spend $75 on caviar? And then I have to figure out what to do with the rest of the $75? Of course not. That just doesn't make any sense. I'm gonna be responsible with my $100. So if I have a investing budget, so I say, hey, I can spend $100 in the stock market. I'm not going to miss it because that's the first thing. I don't need it. That's the second thing. So now I'm like, okay, so where am I going to put it? Well, am I going to invest in a fraction of Amazon, or am I going to invest in companies that I, one, feel comfortable with, but then on top of that, I can actually afford a couple of shares? So those are things that I'm going to say, like, do you invest in a small piece of Amazon, or do you invest in a couple of shares of a company that you know, like, and trust, and that has good management, is a good company? There's companies that, listen, I absolutely love J. Crew. I don't have J. Crew on right now. I love J. Crew, but guess what? J. Crew filed for bankruptcy. I mean, retail has not been doing well at all. So I think that's another thing people need to kind of think about. Like, hey, is this company, I always tell people, is this company going to be around in like 10 years? Is it? Do we think that there might be some problems? So that's kind of what I want people to do when they're looking at stocks or looking at companies to invest in. So like, I've known Macy's is another store that I absolutely love. And I kind of talk about Macy's too, because like I have a thing for leather jackets, but I only have one and I got it in Mexico years ago. But I always look at the leather jackets like, ooh, I love this leather jacket. And I'll look at the price like, oh no, I don't like this price. But in my head, I've already thought to myself like, okay, well, this leather jacket's at $300, but if it goes on sale for $150, I know this leather jacket is quality. I know it's going to last me for a while. Then I'm going to go. So in my head, I've already said, okay, this thing is half off. I'm getting it. That's the same thing I want you to do with the stock market. So you're saying, hey, I'm really interested in XYZ company. Okay, you look it up, you're like, oh, XYZ company is trading at, $90 a share. I'm not paying $90 a share, but I will pay 50, 60, whatever. So kind of put that in your mind. And that's why I tell people, put it on your watch list. So you're watching it like, okay, I see you. Because if you had a watch list, you might have actually made some purchases. I think March 18th was like one of the lower days. So you might have made some purchases and kind of made out like a fat rat had you had a watch list. So I think a lot of people want to like rush into the market. Like, I'm going to buy something right now. And it's like, do you really need to buy it right now? Like, or should you watch it? Should you wait? Like, is that a number that you're comfortable in purchasing? And so I tell people all the time. And again, like, is this company going to be around in 10 years? What do you think about the prospect? And is this company run well? I don't know if everybody remembers The Simpsons, but The Simpsons had like this crazy bus driver. So the like school bus was good, but the crazy bus driver, I was like, whoo, I don't know if I want you riding me around. But that's the same thing with companies. Like when we look at Elon Musk and we're looking at Tesla, And he's like, oh, I'm going to, defy California's orders about not, and I'm not telling you to buy or sell. I'm not telling you to do anything. I'm just giving you an example. He's like, oh, I'm going to defy California, and I'm going to open up my facilities. And it's like, is that a good idea? Because, I mean, if you do that, you're going to probably be subject to fines. You're probably be subject to a lot of litigation, because what if somebody gets hurt there? What if somebody contracts COVID while they're at work or on their way to work? Is the company now liable? Does that kind of open them up for more liability? So here's the thing. So to me, that's another thing I'm going to go, I really like the company. I think you're really doing something, but that guy at the helm, I don't know about that. So again, that's the conversation that you should be having. But we can make those like women, we have those ideas in our head already. It's just about executing them. A lot of people saying, well, what kind of, what do you like to use for brokers? Like, where do you like to buy stocks? I personally like Robinhood to get people started. Now, Robinhood has been a little bit on a glitchy side. I personally use Merrill Lynch. I use E-Trade, and there's a couple other platforms I use, just depends. But I share that with people. It's just to kind of get it started. It's just easy to kind of say, okay, I'm going to open a Robinhood account. I'm going to put some money. I'm going to put $100 in and just see what happens after you kind of do your research. And Robinhood kind of gives you some really good background on some companies. So it's just a really good way to get started. So there's lots of different things that you can do. But I want you to take your personal empowerment, kind of put your shopping hat on, your thinking cap. Whenever you go shopping, you're like, those bananas are not supposed to be $3 a bundle or $3 a pound. That doesn't even make any sense. So you just move on from the bananas. You're like, okay, maybe next week we'll get bananas, but not this week. Same thing with the stock market. Put that thinking cap on. Okay, I looked at these bananas. Oh, okay, now it's 99 cents a pound. That's more like it. Let me get at least a pound, but I think I may get 3 pounds because I don't know what you're doing. I'm going to put them in the freezer for my smoothie. So again, kind of think of it that way. So if you put your shopping hat on, I'm pretty sure you guys are going to be successful because we're just good at it. So.
Sounds good. That sounds incredible. You blessed us with a wealth of information. Only thing I would caution those of you who have not already spent your entire stimulus check as of yet, I don't know if you have enough information. According, we can kind of talk about that. I think for the most part, it wouldn't be my recommendation for people, depending on where you are financially. I think that's extremely situational, depending on where you are financially. Like if you're at the bottom of your budget, then I'm probably not going to advocate for you to take that $200 and put it into the market. That's probably not what you're going to do. But if you are maintaining your job and you're working from home, you got your stimulus check, it really feels like extra to you. I think that the first place, which is why I wanted you to be here, Courtney, would be an educational place. I think following some people online that can really start to, broaden your thinking, broaden your scope as relates to what to buy, what to buy, what to purchase. Courtney, in the comment section, that article that you were talking about as it relates to 401ks, I do want you to drop in and share that with us because it was loaded with information. You also teach some individual courses. So some people maybe not jumping in and say, hey, I'm going to jump into the market. I was hoping that this conversation would be thought provoking, right? To get you to start thinking about some other ways, because oftentimes I do talk a lot about debt elimination, right? And now people are starting to say, Shani, okay, great. You got us to pay off this debt. You got us to get into our first homes. What are some other things that I can do with this money? They need some other motivators. So I do want to provide you with other things that you can do with money outside of paying down your debt. Courtney teaches a few great courses. We're going to drop those in the comment section so that you can have the opportunity to really kind of break down some language, before you jump into the market. Understand what a watch list is. If the whole time that you've kind of looked at your, really, investing, the only is looking at a prospectus and not knowing what it is. That's an indicator that where you need to start at would be investing in education, maybe a course, maybe a class. That way you can sleep at night, right? And you're not calling me saying, Sean, I spent my stimulus check. Okay. Alrighty. Next week, talking about is student loans. We're going to be talking about student loans. For those of you who have questions, we're going to talk about how COVID-19 impacted student loans and how to begin to interact with your student loans to make sure that you can continue to eliminate debt so that when it's time for you to invest, you don't feel some type of way. I hope that you've enjoyed this episode. Thank you so much, Courtney, for joining us today and putting some stocks in our purse, right? We need some stocks. You got stockings, you need some stocks so that you can do two things: protect your money from taxes and inflation is because they won't be there when everyone else leaves. Thank you so much, Courtney. Bye, y'all. See y'all next time.